Good afternoon, this is Todd Colvin coming to you from the floor of the CME Group. We are looking at rates and 10-year note yields making the climb. Finally, getting to and above 3% for a brief moment. We traded 10 years up north of 301. Recall we've done this trade a few times since May. We got up there about a month and a half ago. We got up there, we traded back down to 280, and now we're back up revisiting again, this time a little bit higher. But we are unable to see any real momentous push forward higher in yield. So we end up the day just below 3%, but still pushing the envelope here as far as the range goes, and likely with the idea that we need some kind of catalyst event to push us maybe to 310 or that 312 level that we visited earlier this year. We need something more than just, yeah, yields should be going higher because of inflation, or yeah, yields should be going higher because the Fed's raising rates. I think that ultimately we need some kind of a catalyst push, whether it come from foreign investors, whether it come from the economy here in the U.S., or whether it come from just flat out supply and demand. But we haven't seen that yet, at least not since the late May range. When we talk about that range, talking about that 280 to 3% range, that's really held staunch, and we haven't seen a whole lot of deviating from it. And if you look at market volatility, yes, market volatility saw a little bit of a bid today. Nothing you would write home about, but certainly as we near the edge of the abyss and look over it, it will cause a little bit of angst, and we saw that today. And I think that as we move forward, obviously there's going to be some angst as we lead up to FOMC next week. FOMC not only brings with it a rate hike, but also a press conference, forward guidance, and new dots. Those will all be read under the microscope, and I think that that is going to be one of the reasons why we continue to see market volatility, if not bid, at least hold steady. At least for the next week or so, you can expect that. And lastly, the pre-FOMC trade. We always talk about the post-FOMC trade. What is going to be the pre-FOMC trade? Well, one of the hinges to higher rates, higher borrowing costs, is higher mortgages. And how will that affect the housing market? Well, we do get existing home sales and we get housing starts this week. How will those be affected? We've seen massive declines in those numbers over the last several readings. And how will higher rates affect those? Because if you start to see the housing market slump, that is going to be a signal for the Fed to probably take its foot off the gas. Maybe not this year, in this calendar year, but certainly looking at 2019, they don't want a declining housing market and a raising rates market. When you have savings at all-time lows and equities sort of teetering on the top, I think the market, they want more market stability. And right now, the housing numbers will be something to watch as those 10-year note yields creep higher. So right now, the 10-year note yield at the top end of the range and holding, but a big FOMC meeting next week, that'll be the catalyst. This is Todd Colvin coming to you from the floor of the CME Group.